Hey traders, how's it going? Nick from Vant Trading here, coming at you with another video for the beginning of the year 2022. Now, this video is going to be about some of my top stocks and sectors that I'm going to be watching this year. It'll primarily be focused on the first quarter, mainly because that's the easier to predict and get an edge in, because you never know what will happen by the end of the year. But this is going to be a big, important sector and analysis in terms of market change and what we think is going to be changing and happening in the markets over the next year. So if you've watched my other video where I reference some of the top risk events to 2022, this is going to be on what I'm going to be focusing on for longer term investments and what I think is going to be in play. And I think we're going to be experiencing a market shift and a change in personality for the market. Now, reminder, as always, no one knows where this market is going to go. We could continue to see the same kind of market that we saw last year. We could have a bear market. We could have a bull market. We could have a very choppy sideways market. No one knows. The point here is to think about what you think the edge is going to be in the market, where you think the smart money is going to be, what you think the personality of the market is going to be, what the characteristics of this market is going to be, and to gain the slightest edge to create a plan, manage your risk, and follow through on that plan. So I want you to be watching this video and realizing, how does a professional trader think? What is some of the strategies that I'll be employing? And how do I think about this market right now? And that might generate some completely different ideas for you, and that's great. You need to have your own personality in this market. It's the only way you're going to gain an edge and gain long-lasting survivability and prosperity in this market. So without further ado, let's dive on in here and let's talk about this market, because last year we saw a certain personality in this market, and that was particularly towards the second half of the year that the market was carried by the big boys, the big five, really. The 51%, I believe, of the gains since April in 2021 were from five stocks: Nvidia, Tesla, Apple, Microsoft, and Google. That is it. Those were the ones that were responsible for the majority of the rise in the market. And if you didn't know this, the SPY, the S&P, and the Qs have a lot of the same stocks in them. Let's be honest. It's not this complete separate entities back and forth like you would think, which is why a lot of times they move kind of one and one. So there is a big amount of similarity between those markets. So don't think that, if you're heavily investing in one, you're negating the risk of the other. Okay, so just keep that in mind. So that was the personality of the last market. And if you look at the percentage of stocks trading above their 50-day SMA here towards the end of the year, we really didn't get going. We couldn't get going. And that is because at the end of the year, stocks that were undervalued, they stay undervalued. Stocks that were below their moving averages, they stayed down there. Dip buys and buying weak stocks, it didn't really work out. You didn't get above average returns. Meanwhile, the market was pushing for new highs and was ripping. That's because of Apple running at the end of the year, Tesla running at the end of the year, Microsoft. All of these guys were the same, the characteristics of the market. You watched them, and if they dropped, the market dropped. If they went up, the market went up. I think personally, and we think personally, that is going to change this year. We have seen some overvaluations in a lot of these stocks. We're not going to say that they're going to completely implode or crash back down to earth, but that's not where the easy money and the smart money is going to be made this year. First and foremost, we think that there is going to be volatility. So volatility is definitely going to be more in play this year, in our opinion. It's not just going to be a trend market. It's not going to be just buy the growth stocks and watch them trend higher and higher every single day while volatility continues to remain compressed. No, we think we're going to see a little bit more of a spike in volatility, a little more of a volatile period in the market. So we think that we'll see more periods of choppiness, of whippiness, of stocks moving up and down, people buying undervalued stocks. You aren't necessarily going to be able to just buy the breakouts or short the breakdowns. And we think that there's going to be a lot more movement in this market. Yes, we could see a bear market by the end of the year. There's a lot of stuff that can happen this year. There's a lot of risks to the market. But overall, we don't think that this is just going to be buy growth and watch it go up. We think there's going to be a lot more volatility. So however you want to employ and take advantage of an increase in volatility, whether that's selling options, whether that's playing volatility indexes or volatility funds, whatever it is, we think that is going to be the first area of focus that we'll see start to take over. And we are already starting to see that just in this first week of trading. We've seen some of the bigger volatility indexes, the NASDAQ volatility index has already started to spike. We've already seen some interesting movements out there. Second off, another thing that is kind of obvious here, we're going to be seeing rate hikes this year. It's inevitable. In fact, we're going to be seeing multiple rate hikes at this rate, and we might see the first rate hike in March. So financials will likely do pretty well, especially if growth continues to hold up. Now, that is a question for the entirety of the year, but for the first portion of this year, it seems like growth is doing well. So we are seeing financials already start to pick up. That is likely to continue. And we're seeing some of the undervalued financials really start to catch up. Guys like Citigroup, Wells Fargo's even broken out. JP Morgan is starting to pick back up. Goldman Sachs is doing okay, even though it's the big boy. So financials in general likely to be good. Now, you may want to go in there and find, do you want to play a regional bank? Do you want to play the big banks? Do you want to play the undervalued banks like Citigroup? Or do you want to play the industry leaders like Morgan Stanley, like JP Morgan, like Goldman? That is kind of dealer's choice there. But overall, volatility, rates, financials. This also goes into if growth is going to continue to do well, I'm going to be watching stocks like Visa. Yes, Visa has had a underperforming 2020. We zoom out a little bit, and this is a gradual grinder of a stock, and we think that last year it had a good first half of the year, second half of the year very, very uneventful. And I think that if growth is going to continue, if consumer spending is going to continue, and if rates are going to rise, I think Visa, MasterCard, American Express, those players are likely to set up in a good position. The price action is already dictating that they could be poised for a breakout. So this is another sector that I'll be watching, kind of a branch off from financials. Going into some more specific areas here, I'm going to be watching some commodities, more particularly, at least in the beginning of the year while we're in winter, oil. I think energy plays are going to continue to be good. They've been good for us for the last couple of months. We've been bullish oil with both the energy crisis and with a cold winter and already stretched supplies along a massive influx of demand. So energy plays have been really good. Now, whether you want to play a smaller one like Devon Energy, whether you want to play someone bigger like Chevron, there's a lot of good energy plays out there. It's kind of dealer's choice to an extent there, but those are some of my favorite oil and gas plays. I also think that there could be some other energy plays, not just within oil. I've been particular on uranium. I think there's a lot going on in uranium that's going to give uranium a boost this year. Both Europe filing uranium and uranium energy as green to give tax incentives. Europe's making a big push to create nuclear reactors. You also have issues in Kazakhstan, which is responsible for 42% of the global uranium production. I think uranium is a larger, more longer-term play, but I think that these alternative energy plays are looking a lot more attractive than, say, solar. So there is going to be some good plays, more in particular in the oil, but also in some other offshoot industries there. Some other commodities, I think metals will do relatively well, especially if supply chains continue to be stretched and to be tight. I feel like inflation within the commodity metal prices as production continues to try to ramp up. Some of the chip production tries to continue along, even though that's been seeing some serious issues. So prices like metal, or steel. If you want to look at steel, you can look at companies like United States Steel. If you think of aluminum, Alcoa is already in a bit of a breakout here. NTR was a good one, but they've been having some issues with now 2 CEOs in the last year leaving for some reason. So there are issues within there. Lithium, if you think EV is going to be good, though this has been a little bit more of a volatile commodity in stock lately. Lithium within the batteries is going to be very big if you think that those batteries are going to continue with the serious production that we're seeing. They just had a very good fourth quarter in terms of electric vehicle deliveries, both in China and in the US through several companies. So lithium, another possible one. You could look at iron ore or nickel, someone like Vale, miners, they're just starting to pick up. So I think we're going to see some good plays within the metals as well. And you could be playing that gold-silver ratio. The gold-silver ratio traditionally finds some resistance around 80-1, which is actually where we're at right now. Now, it can shoot higher. We saw it actually shoot to, I believe, all-time highs last year. But this is going to be something to watch, in my opinion, as well, as those metals and the relationships between them. Now, going into some more specific stocks and some more other interesting things, I think value and defensive plays are going to be much more in play. So while people were buying the breakouts and buying the growth stocks and leaving the reopening plays and leaving the value plays in the dust, I think we do see that market rotation. We've already started to see that market rotation. I think it'll continue to persist. First of all, some dividend plays could definitely be in the mix. I've been talking about Verizon for some time. I think they're a great play, especially especially with the 5G rollout. You could look at AT&T as well, though they do have some other things going on in there. Keep in mind with them offloading, I believe, DirecTV and a couple other things going on within the company. But both Verizon and AT&T starting to pick up, pay good dividends. Look for high yield dividend, staple defensive plays. I also like some like Procter and Gamble. Procter and Gamble has an okay dividend, but you can see it already starting to pick up. PepsiCo as well, Mondelez, MDLZ, General Mills. You want some more dividend plays? You have people like Altria. They pay a relatively strong and healthy dividend. They're actually in a bit of an uptrend as well. Philip Morris, if you're looking for cigarettes/weed, but they also pay a nice healthy dividend. They just crossed over the 200-day. You actually have a lot of potentially good dividend plays out there that I think people will park in for some safety, collect a little extra cash, and we'll see, I think, a little bit of a resurgence in some of these defensive plays. Now, it's not just because of the dividends, but it's also because these are consumer staple plays. Consumer staples have been doing very, very well over the last month or two. Some other plays out there, if you think that kind of defensive sector like Coke and Mondelez and PepsiCo and Procter & Gamble are going to do well, then Berkshire Hathaway is likely to do well. We're already seeing them have a banner start to the year. So I think Berkshire Hathaway is going to continue to do relatively well, especially if we continue to see rotation into the sector and if the real estate market holds up relatively well. So this is another company that's likely going to capitalize pretty well on some of their investments. That's kind of our value defensive sector. There's a lot of stocks like that in that sector. I think IBM has a lot of potential as well, though you got to realize that they are in the middle of bumping up into some serious descending highs here, about 10-year long descending highs that we failed off of. I'd love to see us break out of this. I think that could be a massive, massive move. Some other big staple plays that aren't necessarily defensive, but I still think are big companies that are going to see some value rotation into. First of all is Walmart. Walmart is a company that just doesn't seem to ever drop. Doesn't go anywhere either. Didn't drop during COVID. Really just kind of chopped around. We picked up slightly at the end of 2020, and 2021 was spent just chopping and flagging. I think 2022 could be a strong year for Walmart. We're poised. We're coiled. We need to see the price action confirm, but it feels like we're about to break out. And I'm definitely a big fan of Walmart going into the first quarter of the year, as long as the market holds up. Also, Disney. I am going to say it. Disney is starting to pick up. We've seen some underperformance from the mouse lately. It's a bit of a reopening play. They have a lot of other things as well. Very good box office numbers from Spider-Man and so on. So I'm looking at Disney. I think Disney could continue to pick up as well. Those are some more kind of big boy companies. Another one, so we've also seen some of the vaccine makers do well, and healthcare in general has been a leader last year. I think we're going to have to be a little choosier in this sector. I don't think the sector is necessarily going anywhere. AbbVie is one that has had a very good last month or two, a little high right now. I'd like to see this one pull back, but they do have a good dividend as well. Another one is Johnson & Johnson. So while Pfizer had their time in the sun, it feels like they're starting to feel a little bit of pressure. Myrna, obviously, I don't want to own this with a 10-foot pole. Johnson & Johnson, however, has a lot going for it. They have the vaccine. They have a big, I believe, 3-part spinoff that is happening. So they're going to be spinning off three different parts of their company. Big amount of hype for a lot of people who like that kind of stuff. They're just starting to break out. It's a nice staple play. They do pay a dividend. It's okay. I think that this is a borderline no-brainer for me also as well. So I'm going to be watching that stock very, very closely. That's a lot of kind of the big boy companies, a lot of the kind of staple defensive plays that I'll be watching. There are also some other interesting speculative plays I'll be watching. I'll be watching FedEx. I think that if the economy is going to continue to grow and have a decently robust 2022, I do think that we see some trouble and experiences out there. I talk about that in the other video. But I think FedEx, if it can get up over the 200-day, I think we'll see that do well. Mike likes to look at stocks like FedEx and UPS as almost a barometer for how the economy's doing. If people are shipping and they're paying to have things shipped and they're having things shipped to them by buying things, then typically these stocks will have good earnings and they'll typically do well. Some other interesting plays, Ford. So we obviously saw Tesla go crazy and have fun. It feels like Ford's now starting to pick up that slack. They've had some serious demand for their electric pickup trucks. There are some pressures, obviously, from the administration in terms of starting to now challenge how many miles per gallon these cars need to have. So that could be headwinds for them. But right now we're seeing Ford, General Motors, and a couple of those stocks really start to pick up as well. I think that they could continue as well. Ford, borderline a staple play, pays an okay dividend from time to time, but I think that they do have some slight potential, though maybe not as much as others. Here's a little shot in the dark play I just wanted to throw at you because, sometimes I do like to have a little YOLO, a little bit of a spec play in there. Hertz. Yep, you heard me right. Hertz. Hertz is back. They're out of bankruptcy. They've ordered all of these Teslas, and apparently they're going to be they're going to start this rollout this year of these Teslas, of stuff like this. Now, it is Hertz, yes, and there's a lot of things in there. This isn't a fundamental play necessarily. This is a little bit of a spec play, but Hertz's volume has been picking up. It has been holding pretty nicely. They've gotten through bankruptcy relatively unscathed. They have this Tesla hype behind them. I feel like Hertz does have potential in here, so this is a little bit of a fun play for me this year. Some other stocks, kind of zooming out a little bit, look at buybacks because last year was one of the biggest record years in buybacks the stock market has ever seen. Stock buybacks are massive. They drive this market. Some people say that they're responsible for 40% of the gains in the entire market over the last decade because of the growth in EPS and the growth in performance due to stock buybacks. If we continue to see that trend and we continue to see companies buy stocks back, that could be a driver for a lot of companies. So just keep an eye open and an ear open for whoever may be buying back massive amounts of stock. It could help elevate the gains of this stock because that is a big driving force in companies. We've seen a lot of companies out there like MasterCard and other stocks start to buy stock back. So just keep that in mind. Now, if rates do start to rise, money gets tight for companies, and we may see buybacks ease, but just keep an ear open for that. A potential play later this year, though not right now, is going to be NFTs. I think NFTs are a much longer term play. I think that technology is still relatively new, but I think NFTs within Ethereum and whatever do have a long-term future and do have a lot of interesting things. And I think we're going to start to see a lot of companies incorporate NFTs more and more into their businesses, whether that's to ride the hype train or whether it's to try to capitalize on a new and growing technology. I think we will start to see a rise in NFTs both in gaming, in movies, in art, and a lot of other entertainment aspects. So I think anything with NFTs could start to gain some hype this year. That's still up in the air whether that's going to happen this year or not, but it's still something I'm keeping a close eye on. And that same NFT space, I'm going to be watching Meta. They changed their ticker on Q1 this year. I don't believe we have a specific date yet, but they've got the whole metaverse play. That is a very long-term play. It's like a 10-year perspective for them. But I am definitely more in favor of someone like Metaverse as opposed to someone like Twitter. I'm not a fan of Twitter. I'm not a fan of what the administration or the leadership's been doing there. They've had this leadership turnover. I think they're doing some very strong-willed things with that company, and I'm a little worried that this company is going to be an underperformer this year if they don't stop kind of rattling the cage and pissing off Congress. So I'm a lot more in favor of someone like Meta per se than Twitter. Meta is going to be a very interesting play. It's definitely going to be interesting to watch going into that ticker change. A stock that Mike really likes, if you want to go reopening plays, is going to be someone like Live Nation. Now, Live Nation's had a pretty good year last year, so we want to see how we can start this year off. A little choppy at the moment, but if reopening is going to continue, live concerts, live performance, Live Nation, definitely a stock that Mike likes to play, and he does have some pretty good history and results with it. Some other plays that I want to watch, if you think that the big boys aren't necessarily going to go anywhere, then I would look for some of the quote-unquote underperformers. I think Amazon has been a relative underperformer. I think they do still have that buyback potential in the back of the minds of investors, and I think that hype could show itself at some point. I do think that Google will continue to do well this year. I don't see any reason why I would think that Google would have issues this year by any means. I think that Google is still a powerhouse in this market and in this world. So I still think Google is pretty poised. I love Microsoft as a company. I'd love for them to come back down lower so I can buy more. So I'm frankly fine watching Microsoft very closely. And as a little bit of a joke, but not really a joke, let's be honest, buy anything Nancy Pelosi buys because let's be honest, she's the one who's outperforming the market the most. The politicians, the actual inside traders out there, let's be honest, there is insider trading in this market, and it's done in Congress, it's done in the White Houses, it's done in the administrations, it's done at the Fed. So anything that Nancy's buying, anything that those people are buying, they're outperforming the market, they're outperforming all of the funds because they know exactly what they're doing. And look, if you see that Nancy Pelosi's buying more shares of Google or Disney or Roblox, which she is, those might be companies worth taking an eye at. So those are, I hate to say it, but it's true, and it's what happens in this market right now. Some sectors that could be in play, we'll see. A lot of potential in them. Weed isn't going to be changing anytime soon unless we can start to get some policy change, unless we can start to see legalization at least, or decriminalization rather, because what the big issue is that they can't keep their money in banks, they can't invest their money, and then it's still kind of this gray area financially for the weed companies. But that could change this year. There was hope last year for that to happen. It didn't happen. As we go into the midterms and as the Democrats start to sweat and feel the pressure of losing popularity, they may start to push some legislation for this sector. Could be worth watching. Another sector, or rather stock that could be interesting, Tesla. Yep, I'm going to say it. A lot of people want this thing to crash. I think there's going to be potential here, both either on the up or downside. I think we're going to see a big move from Tesla in either direction. I think there's going to be some great short-term trading in here. We're going to have to be very, very careful if we do touch this thing, because there's a lot of people on both sides who are very adamant on their positions. So we need to be careful and we need to watch closely. I definitely think it's going to be a short-term momentum trader's dream, though, this year. Talking about one last sector, the semiconductor sector, because we saw them have a very strong 2021. 2022 is going to be interesting because they are still experiencing record high shortages, record high supply chain issues. They are feeling the pinch. And stocks like Nvidia, look, I don't think they're going anywhere. They have a lot of hype, both with autonomous driving, AI, some of the gaming stuff they're doing. Nvidia, I love them as a company. They feel a little overvalued up here for me. I'd like to see them pull back. If they do another split, though, all bets are off. These things are going to run. I have been playing and have been watching, if you've been watching me, playing some of the underperformers. Micron has really picked up the slack. Intel is starting to wake back up. They're still compressed down their 200-day, so the jury's still out if this is going to be a long-term performer this year. But I'm looking at some of the underperformers in this sector. I want to see if they start picking up. On Semiconductors kind of picked it up. AMAT's been doing pretty well. Taiwan Semiconductor could be good, but there's a lot of pressure from China out there, so we're going to have to be careful there. But I think the semiconductor sector as a whole is likely to underperform this year, but I think there are going to be some good moments and some good companies in this sector that'll do better than others. Going into my final sector, because I mentioned China, there could be a potential for some China plays here. Alibaba's starting to pick back up. We've seen Charlie Munger double, triple, quadruple down or whatever in his position in here. Yes, these companies are fundamentally undervalued. However, there is a lot of risk in China plays right now from two reasons. One, China is experiencing some serious economic pressure with their COVID zero tolerance policy, serious lockdowns, energy crisis out the ass that's causing them to shut down and energy ration, and a lot of other political pressures. China feels the pressure in these companies, which is why they very underperformed last year. And we never wanted to play any of these plays because it was dangerous. And two, headline risk. Chinese government needs to stop pressuring, stop diving their hands in there. Now, let's be honest, they're never going to, but they are right now, the Chinese government has been pressuring their companies to delist from U.S. markets and to come home and list on their home exchanges. I don't think that pressure goes anywhere necessarily, especially once China figures out their economic issues. Whether that happens in a positive or negative manner, they've got Evergrande, they've got their property sector having issues. There's a lot of risk over there in that sector and in that country. I think there could be some potential here if things start to quiet down. If people look for undervalued plays like Alibaba, I think we could see some performance in here to the upside. We'll have to see how long it lasts. Again, the game of politics is a very tricky thing, and it can come and go as the market wishes, so it's going to be interesting. That's a lot of the plays that I'm watching. Yes, the airlines will likely do well, though they have some serious labor issues and energy issues. They're starting to pick back up. Cruise lines are doing okay. They're not my favorite sectors out there. Reopening in general could do well. Maybe you look at a casino. Maybe you look at something like Live Nation, whatever you like. Regardless, I think we've covered a pretty good scope in terms of the personality shift that I think we'll see in the market, because let's be honest, markets change. I've now traded for 10 years or so, and I've seen several different markets. What worked last year may not necessarily work this year, and we're going to be watching this first earnings season towards the end of January very, very closely, because some of the earnings plays that we see might change. We might see people bottom buy off of bad earnings, or buy underperformers, or sell and take profits on overperformers after good earnings. We may see some very interesting things out there. It's going to be very interesting. It's going to be a very interesting year of trading. So this is kind of my Q1 video, if you will. But these are sectors and some themes that I think will likely persist throughout the year. There's so much more in this market I didn't cover. I didn't really talk about real estate. I didn't talk about home builders. I didn't really talk about industrials. There are so many things out there that we could play, so much opportunity. But the key is to try to peg what kind of market this is going to be, what's going to be working. Risk management is going to be very important in a year like this. And I think that it's going to be great for stock pickers and short-term traders alike. So I hope that this was helpful, informative, or at least entertaining. I appreciate you all for tuning in. And as always, safe trading.